Look, I need to tell you something that most silver dealers won't admit, and it's costing people thousands of dollars in lost opportunity every single day. You walk into a coin shop or you're browsing online, and you see these massive silver bars, 100 ounces, 400 ounces. Some places even sell 1,000-ounce bars, and the price per ounce looks incredible. You're thinking, this is it. This is how I maximize my silver position. Lowest premium possible. But here's what nobody tells you until it's too late. When you need to sell that bar, when you need liquidity, when the market's moving and you want to take profits, or you need cash for an emergency, you're stuck. You're completely stuck. Let me paint you a picture of what actually happens. It's March 2024. Silver just spiked to $32 an ounce. Guy named Robert, he's been stacking for 5 years. Smart guy. Engineer. Did all his research. He bought 10 100-ounce bars back when silver was $18. Paid the lowest premiums he could find. Felt like a genius. Silver hits $32 and Robert decides it's time to take some profits. Maybe buy back in on a dip. He calls his local dealer. Hey, I've got a 100-ounce bar I want to sell. Dealer says, great, bring it in. Robert drives 40 minutes to the shop. Dealer tests it, looks at it, then says, I'll give you spot minus $2. Robert's confused. Minus $2? Silver's at $32. You're offering me $30 per ounce? Dealer shrugs. That's the market for 100-ounce bars. I've got 3 sitting in my safe right now. Nobody wants them. They're hard to move. I'll give you $3,000 for it. Robert does the math in his head. At spot, that bar should be worth $3,200. He's losing $200 just to get his money out. That's not even counting the premium he paid going in. He tries another dealer. Same story. Tries to sell it online. Shipping a 100-ounce bar? Insurance alone is $150, and buyers are skeptical. How do I know it's real? Can you get it assayed? Now Robert's looking at assay fees, another $100 to $200. By the time he actually sells that bar, he's lost $400 to $500 on a $3,200 position. That's 12 to 15%. Gone. Just to access his own money. Compare that to his buddy Mike. Mike bought 100 1-ounce rounds instead of one 100-ounce bar. Same amount of silver. Yeah, Mike paid higher premiums going in, maybe $2 more per ounce. But when silver hit $32, Mike sold 20 rounds in an hour on a local Facebook group. Got spot plus $1. Sold another 30 to a dealer. Got spot. Kept 50 for the next run-up. Mike had options. Mike had liquidity. Mike could sell exactly what he needed, when he needed it. Robert? Robert was all or nothing. And all meant taking a massive haircut. This is the liquidity trap. And it's not just about selling at the top. It's about every scenario where you need to access that wealth. Medical emergency, business opportunity, market crash where you want to buy real estate. You need $5,000 fast. You've got a 100-ounce bar worth $8,000. Congratulations. You have to sell the whole thing and take the hit on the other $3,000 you didn't need to sell. Now, dealers will tell you, but look at the premium savings. And they're not wrong about the math going in. A 100-ounce bar might cost you $1 over spot. 1-ounce rounds might be $3 over spot. On 100 ounces, that's a $200 difference. Feels significant. But here's what that math doesn't account for. The bid-ask spread on the way out. The flexibility cost. The opportunity cost of not being able to take partial profits. The emergency cost of having to liquidate more than you need. I talked to a dealer in Texas who's been in the business for 30 years. He told me something fascinating. In 2011, when silver hit $49, I had people coming in with these monster bars. 100-ounce, 400-ounce. Even saw a few 1,000-ounce bars. They wanted to sell at the top. Smart move, right? Except I couldn't buy them all. I didn't have the cash on hand, and I already had too much inventory in large bars. I was offering spot minus $3, minus $4 on some of them. People were furious. But what could I do? I can sell 10 1-ounce coins in a day. A 100-ounce bar might sit in my safe for 6 months. That's the reality of the market structure. Retail demand is in small denominations. 1-ounce rounds. 10-ounce bars max. That's what people want to buy. That's what moves. Large bars? That's wholesale territory. That's dealer to dealer. That's refinery business. And in that world, you're not getting retail premiums. You're getting wholesale bids. Think about it like real estate. You can own a $500,000 house, or you can own 5 $100,000 condos. The house might be easier to manage. One property, one set of paperwork. But when you need money, you have to sell the whole house. The condos? You can sell one. Keep the cash flow from the other 4. That's liquidity. That's flexibility. Silver's the same way. A 100-ounce bar is the house. 1-ounce rounds are the condos. And in precious metals, liquidity is everything. Here's another angle most people don't consider. Verification. When you're selling a 1-ounce American Silver Eagle or a Canadian Maple Leaf, verification is simple. Dealer has a Sigma tester, takes 5 seconds. Done. Everyone knows these coins. Everyone trusts them. They're government issued. They have anti-counterfeiting features. A 100-ounce bar? That's a different story. Dealers looking at it carefully. What's the mint? Is it a recognized brand? Johnson Matthey, Engelhard, Royal Canadian Mint. Okay, those are trusted. But some random private mint? Now we've got questions. Dealer might want to drill it, might want to send it for assay. You're paying for that. Time and money. And here's the thing that really gets people. Counterfeit risk is higher with large bars. Not because they're counterfeited more often, but because the payoff is bigger. Fake a 1-ounce coin, you make $30. Fake a 100-ounce bar, you make $3,000. So dealers are more cautious, more skeptical. And that skepticism costs you money. I know a guy who bought a 100-ounce bar at a coin show. Looked legit. Had the right stamps, right weight. He held it for 3 years. Went to sell it. Dealer tested it and found it was silver-plated tungsten. Worthless. Guy was out $2,500. Could he have been scammed with 1-ounce coins? Sure. But the financial hit would have been $30, not $2,500. And he would have caught it after the first coin, not after buying the equivalent of 100. Now I can already hear some of you saying, but I'm not planning to sell. I'm holding for the long term. I'm buying for wealth preservation, not trading. Fair point. But let me ask you this. What's the point of wealth preservation if you can't access that wealth when you need it? Your wealth isn't preserved if it's locked up in an illiquid form. That's not preservation. That's imprisonment. Real wealth is accessible. It's flexible. It's there when you need it, in the amount you need it, without massive transaction costs. And here's the scenario nobody thinks about until it happens. You're holding silver for the big one, the dollar collapse, the currency crisis, the moment when precious metals become the only real money. Okay, great. That moment comes. You've got your 100-ounce bar. Now what? You go to buy groceries. You need $200 worth of food. You've got a $3,000 bar. The store owner looks at you like you're crazy. I can't make change for that. I don't have $2,800 in goods to trade you, and how do I even verify this thing is real? But if you've got 1-ounce rounds, now we're talking. Here's 6 ounces. That should cover it. Store owner can test one coin, can make change, can actually transact with you. That's the whole point of having physical silver. It's supposed to be money. But money needs to be divisible. A 100-ounce bar isn't divisible. It's a brick of wealth you can't spend. The Romans figured this out 2,000 years ago. They didn't carry around 100-ounce silver ingots. They had denarii, small silver coins, divisible, spendable, liquid. We've somehow forgotten this basic principle of monetary metals. Now, let's talk about the premium argument more carefully, because this is where dealers really get you. They'll show you the math. 100-ounce bar, $1 over spot. 1-ounce rounds, $3 over spot. You're saving $200 per 100 ounces. Sounds great. But what they don't show you is the total cost of ownership. You're not just buying silver. You're buying the ability to sell silver. And that ability has a cost. It's called the bid-ask spread. On 1-ounce rounds from major mints, that spread is tight. Maybe $1 to $2. You buy at $3 over spot. You sell at $1 to $2 over spot. Your round-trip cost is $1 to $2 per ounce. On a 100-ounce bar, you buy at $1 over spot. You sell at $2 to $3 under spot. Your round-trip cost is $3 to $4 per ounce. You actually lost money on the premium game. You saved $2 going in, you lost $4 coming out. Net loss, $2 per ounce. Times 100 ounces. That's $200, the exact amount you thought you were saving. And that's in a normal market. In a volatile market, when everyone's trying to sell at once, that spread on large bars gets even wider. I've seen dealers offer spot minus $5 on 100-ounce bars during panic selling. Meanwhile, 1-ounce government coins, still getting spot or better. Quick aside here because this is relevant. If you're sitting on $100,000 or more in retirement accounts and you're thinking about precious metals for wealth preservation, I put together a free guide on how gold IRAs work. It's in the description. Covers how to get physical gold into your retirement account without tax penalties, and it talks about the liquidity considerations we're discussing here. Worth checking out if that's relevant to your situation. Anyway, back to the liquidity issue, because there's another layer to this that's even more important. Market timing. Silver's volatile. We all know this. It can move 5% in a day, 20% in a week. If you're holding large bars, you can't take partial profits. You're either all in or all out. That's a massive disadvantage. Let's say you bought at $20. Silver runs to $30. You think it might go to $35, but you're not sure. You'd like to take some profits, but keep some exposure. If you've got 100 1-ounce rounds, easy. Sell 30. Lock in a 50% gain on 30% of your position. Let the other 70 ride. If silver goes to $35, great. If it drops back to 25, you've still got profits locked in. But if you've got one 100-ounce bar, you're stuck. You either sell the whole thing and miss the potential move to 35, or you hold the whole thing and risk giving back all your gains if it drops. That's not a position you want to be in. This is why professional traders and serious stackers focus on liquidity. They know that being able to adjust position size is worth more than saving a few dollars on premiums. They know that flexibility is a form of wealth in itself. I talked to a guy who runs a $50 million precious metals fund. He told me, "We never buy anything we can't sell in 24 hours at a reasonable price. Ever. I don't care if we're paying an extra 2% in premiums. That 2% is insurance. It's the cost of liquidity. And liquidity is what lets us manage risk." Now, he's talking about institutional size, but the principle applies at every level. Whether you've got $5,000 in silver or $500,000, liquidity matters. Maybe it matters more when you have less, because you can't afford to take big hits on transaction costs. Here's another real-world example. 2020, March. COVID panic. Everything's selling off. Silver drops from $18 to $12 in 2 weeks. Then it starts to recover. By August, it's at $29. That's a 140% move in 5 months. Guy named Tom. He had $20,000 in silver, all in 100-ounce bars. Bought them at $16. When silver hit $12, he wanted to buy more. Huge opportunity. But he couldn't. He didn't have cash. His silver was locked up in these bars. He couldn't sell one bar to raise cash because he'd be selling at the bottom, so he just watched. His friend Sarah, she had $20,000 in 1-ounce rounds. When silver hit $12, she sold $5,000 worth, took a small loss, used that cash to buy $5,000 worth at $12. Then when silver ran to $29, she sold that $5,000 position for $12,000. Profit, $7,000. Meanwhile, Tom's position went from $20,000 to $36,000. Sounds good, but Sarah's went from $20,000 to $43,000. The difference? Liquidity. The ability to trade around the position. Now, I'm not saying everyone should be trading their silver. Most people shouldn't. But having the option is valuable. And you only have that option if you have liquidity. Let's talk about inheritance and estate planning, because this is another area where large bars create problems. You pass away. You've got 10 100-ounce bars. That's 1,000 ounces of silver. You've got 3 kids. How do you divide that fairly? You can't. Not without selling bars and splitting cash. And whoever's handling your estate is going to take the path of least resistance, which means selling to a dealer at wholesale prices. Your kids lose 10 to 15% right off the top. But if you've got 1,000 1-ounce rounds, easy. 333 rounds each, plus one extra that they can sell and split the cash. Clean. Fair. No forced liquidation at bad prices. This stuff matters. Precious metals are supposed to be generational wealth, but generational wealth needs to be transferable, divisible, liquid. Here's the thing about premiums that really bothers me. The industry has trained people to obsess over premiums going in and completely ignore transaction costs going out. It's like buying a car and only caring about the purchase price, not the resale value. That's backwards. Smart money thinks in round trips. What's my total cost to get in and out of this position? On 1 ounce government coins, that round trip might be $3 to $4 per ounce. On 100 ounce bars, it's $4 to $6 per ounce, sometimes more. You're not saving money, you're losing money. You just don't realize it until you try to sell. And here's the psychological trap. Once you've bought a 100 ounce bar, you're committed. You've made the decision. You're not going to sell it and buy 1 ounce rounds because that would mean admitting you made a mistake. And it would mean taking a loss on the transaction. So you hold. You tell yourself it's fine. You're long-term. You don't need liquidity until you do. Until life happens. Until opportunity knocks. Until emergency strikes. And then you're stuck. You're taking whatever bid you can get, and you're losing money. I've seen this play out hundreds of times. People buy large bars to save on premiums. They hold for years. Then something happens. They need money. They go to sell. They're shocked at the offers they get. They feel ripped off. They blame the dealer. But it's not the dealer's fault. It's the market. Large bars are illiquid. That's just reality. Now, let's talk about the optimal strategy. Because I'm not saying never buy anything larger than 1 ounce. I'm saying be strategic. Think about your stack in layers. Layer 1. Maximum liquidity. This is your emergency fund, your trading stack, your I might need to sell some of this layer. This should be 1 ounce rounds or coins from major government mints, American Silver Eagles, Canadian Maple Leafs, Austrian Philharmonics. These are the most liquid silver products in the world. You can sell them anywhere, anytime, at tight spreads. Layer 2. Balanced liquidity. This is your core holding, your long-term stack. Here you can use 10 ounce bars from recognized mints, still liquid, still easy to sell, but slightly better premiums than 1 ounce products. This is your sweet spot for most of your holdings. Layer 3. Lower liquidity, lower premiums. This is your deep storage, your I'm probably never selling this layer. Here you can use larger bars, maybe 100 ounce, but this should be a small percentage of your total stack, 10% to 20% max, and you should only go here if you're absolutely certain you won't need this liquidity. Most people do it backwards. They put 80% in large bars and 20% in 1 ounce products. Then they wonder why they feel trapped. Flip that ratio. 80% in liquid products, 20% in large bars if you want them. Now you've got flexibility. Now you've got options. Here's a real scenario that happened last year. Silver's at $24. Guy has 500 ounces, 400 in 1 ounce rounds, 100 in a single bar. Silver spikes to $32 on some Middle East tension. He sells 200 of his 1 ounce rounds, locks in $1,600 in profit, keeps his 100 ounce bar and his other 200 rounds. Silver drops back to $26. He buys back 150 rounds with his profit. Now he's got 450 ounces plus $1,200 in cash. Started with 500 ounces worth $12,000. Ended with 450 ounces worth $11,700 plus $1,200 cash. Total, $12,900. He made $900 by having liquidity. If he'd had all 500 ounces in 5 100-ounce bars, he couldn't have done that. He would have had to sell a whole bar or nothing, and selling a whole bar at $32 would have meant missing the chance to buy back lower. Or not selling and missing the profit opportunity entirely. This is the power of liquidity. It's not just about being able to sell. It's about being able to manage your position. Adjust. Adapt. Take advantage of opportunities. Protect against risks. Now some of you are thinking, but I'm not a trader. I'm just stacking. I buy and hold. I get it. But even buy and hold investors need liquidity. Because life isn't static. Your needs change. Your goals change. Opportunities arise. Emergencies happen. The guy who says, "I'll never sell," is the same guy who ends up selling at the worst possible time because he has no choice. The guy who maintains liquidity is the guy who can choose when to sell, if to sell, how much to sell. That's power. That's control. That's real wealth. Let me tell you about one more scenario. And this one's important. It's 2028. Silver's at $50. You've been stacking for 10 years. You've got 2,000 ounces, all in 100-ounce bars. 20 bars. You want to sell half. Take some profits. You've got $100,000 in gains, life-changing money. You call dealers. They're overwhelmed. Everyone's trying to sell at $50. Dealers are offering spot minus $4. You're losing $8,000 just to get out. And they don't want all 10 bars. They'll take 5. Maybe. You try online. Shipping and insurance for 10 100-ounce bars, $500. Plus you're waiting 2 weeks to get paid. Plus the risk of shipping that much value. Compare that to having 2,000 1-ounce rounds. You sell 500 locally in a week. Get spot plus $1. Sell another 500 to a dealer. Get spot. You're out at $50 with minimal friction. You keep the other 1,000 for the next leg up. You've got control. You've got options. You've got liquidity. That's the difference. That's what you're really buying when you pay those extra premiums on 1-ounce products. You're buying flexibility. You're buying control. You're buying the ability to act when you need to act. And here's the final piece that ties this all together. The premium you pay on 1-ounce products isn't really a cost. It's an investment. You're investing in liquidity. And that liquidity pays dividends every time you need to make a decision about your stack. Every time you want to take partial profits. Every time you need emergency cash. Every time you want to rebalance. Every time opportunity knocks. The guy with the 100-ounce bars? He's got no options. He's locked in. He's hoping he never needs to sell. He's hoping the market's liquid when he finally does sell. He's hoping dealers are buying. He's hoping he doesn't need to split his position. That's a lot of hoping. That's a lot of risk. The guy with 1-ounce rounds? He's got options. He can sell some or all. He can sell today or tomorrow. He can sell locally or online. He can trade with individuals or dealers. He's not hoping. He's choosing. That's the difference between illiquid wealth and liquid wealth. So here's what you need to understand. When you're buying silver, you're not just buying metal. You're buying a financial tool. And like any tool, it needs to be fit for purpose. If your purpose is wealth preservation, emergency funds, portfolio diversification, or potential profit-taking, then you need liquidity. You need divisibility. You need 1-ounce products. If your purpose is absolute lowest cost per ounce, and you're certain you'll never need to access this wealth in pieces, then maybe large bars make sense. But be honest with yourself. How certain are you really? Life is unpredictable. Markets are unpredictable. Needs change. Goals change. The smart play is to prioritize liquidity. Pay the premium. Get the 1-ounce rounds. Sleep better knowing you've got options. Because in precious metals, like in life, options are valuable. Flexibility is valuable. Liquidity is valuable. And sometimes, the cheapest option up front is the most expensive option in the long run. Don't lose liquidity trying to save a few dollars on premiums. It's not worth it. Your future self will thank you for buying smart, not buying cheap.